As a founding partner of DRC, one of the leading investment management firms in the real estate debt space in Europe, you started your career with Citibank in the 90s, moved to fixed income, have experience with RMBS, CMBS in Europe, originating loans, structuring, syndication. Around 2000, went to Merrill Lynch, if I recollect, and opened and set up the fixed income trading desk for securitizations, and have been very active across the different debt instruments. And then to start DRC, I think everyone who doesn't know, DRC stands for Dale, who was here last year, Rob, and Cyrus. So the three of you started the company in 2012 to become one of the leading alternative lenders in Europe in the real estate debt space. You've seen the emergence of the sector for quite some time. Give us an insight into what were the main drivers behind the asset class forming in the US and in particularly in Europe, and sort of what were the main impulses also that got you to start DRC?
I would say a couple of different things. Whenever you start a business, I think you're looking for an opportunity where there is a fundamental supply-demand imbalance. You're looking for an opportunity where, in order to be able to sell your product, there are a lot more people that want to buy it versus the competition that's available. And that, I think, is the main characteristic of the real estate debt market and actually still exists today. Now, the reason why that dynamic existed at the time that we started our business was twofold. The global financial crisis, we were kind of in the middle of, which had an effect on property values and people's perception of what they could do in property, coupled with the fact that regulation was changing such that the way that Europe was structured, and Henry talked a little bit about this earlier, meant that our strong view was that this completely bank-dominated market was going to change and look a bit more like the United States, where there is a much more diversified list of people that provide real estate debt. And so if we sort of hark back to the times of what people were thinking about back in 2008, 9, and 10, we thought that the market is going to look more like the US. We've just gone through a period of significant repricing, and often the best times to invest are just after periods of a significant repricing. That was balanced by the fact that it was also tremendously difficult to raise money at the time. But again,